Hello again and welcome back to another segment of Retirement Essentials. In today's short video, I want to share with you a recent Facebook Live that I did talking about the COVID-19 era tax planning opportunities. Tax planning opportunities like tax loss harvesting, mutual fund repositioning, Roth Conversions, and HSAs. So definitely jump right in and enjoy this video.
Are we live? I can't see anything here. I don't know. Are we live? I have my mask over my eyes. Oh, is this where this goes? Is this where this goes right here? Is this a little bit better? So a COVID mask does not belong on your eyes. It belongs on your face. That's where you got to keep it safe, right? The same type of silly thing can be drawn to those of us that are not opening our eyes to looking at some of the tax planning opportunities that are all around us. So it's good to see all of you again here on Facebook Live. My name is Devin Peterson. I'm an RICP and founder and educator of the Brighter Wealth Academy. And today in our Facebook Live, I want to share with you some tax planning opportunities that many do not see because they got their face mask over their eyes and not on their mouth. But I want to share these with you in light of the changes legislative-wise and economic-wise that have happened in the last year. And I want to point these out so you can make some impactful changes inside of your retirement finances. All right. So the things I want to share with you today are several tax planning opportunities. One of them is called tax loss harvesting. The other one is mutual fund repositioning, and then Roth IRA conversions. And then I want to finish off talking about health savings accounts. Yeah, those general health savings accounts that you should be contributing to every year for future medical costs. That one. So we're going to talk about those four and hopefully really draw it back to what is beneficial for you, and you can consider for yourself where and how this applies to you. So the first one, we're going to jump right in. Tax loss harvesting. So tax loss harvesting is where you have an appreciated asset that during the time like we're in now, where the market drops significantly and is still negative, you can sell that position low to offset any capital gains into the future in that tax year. And so in 2020, there's been a lot of portfolio shakeups within your retirement accounts or your non-retirement accounts. It's particularly those non-retirement accounts where this tax strategy can really shine with you. And so what that would look like is if you look in your brokerage account and you've seen some negative losses, what you do is you sell those positions. You can't buy back the same position within 30 days, but you can buy back similar type equity holdings, lock in those losses, reinvest those assets to be able to grow in a different position and rebound to offset any of those losses. So this is something that you can work with your tax planner to find a good mix on what those look like, and with your advisor to find the exact positions. But those losses can actually be used partially to offset any ordinary income, albeit it's minimal. I think it's about $3,000 a year that you can offset or deduct against your ordinary income. And then the remaining unused capital loss amount, you can actually spread out over a period of years. So when planned properly during this last March market dip or a future market dip inside of 2020, you can harvest some of those losses, and then you can benefit from those losses for years to come in offsetting against capital gains. Fair enough? All right. So let's go on to this next one where it's called mutual fund repositioning. So mutual fund repositioning is inside of a portfolio that you may be what we call a legacy account. So for a high net worth individual, you might have an account that is primary goal is to pass on to the next generation. However, because of inefficiencies, you've probably not rebalanced that account or adjusted some of those accounts to keep up with growing technology markets or whatnot. And so they might be just in these mutual funds that in a non-market downturn, you might incur some pretty extreme tax consequences if you were trying to repositioning those at that time. However, while the market is down, some tax planning opportunities would be take advantage of that opportunity to sell some of those positions, reposition them into a better suited long-term investment for the next generation without occurring some significant tax ramifications. So that's mutual fund repositioning. And the next one I want to talk about is Roth Conversions. And for those of you that follow me on Facebook and follow our academy, this should not be a new topic. Roth Conversions, I believe, are one of the strongest tools that you can use in 2020, and quite frankly, as soon as you can, to transition out of some higher tax liabilities in the future and take advantage of some of the lower tax brackets now. So let me kind of back up to explain why I feel that so strongly. Well, in 2017, the Tax Cuts and Jobs Act was passed that effectively reduced the tax brackets across the board. So most likely for 2018 and 2019 for you are in a lower tax bracket because of some of those changes. So the question would be, are you going to be in that same lower tax bracket when you eventually are forced to take out and pay taxes on your retirement accounts? It's a great question. It's a great question to consider. Some additional information that would really be an argument for taking advantage of a tax planning opportunity like a Roth conversion would be the changes that happened in the Secure Act in the end of 2019, where they extended the required minimum distribution age from 70.5 to 72, as well as the CARES Act that was passed back in March of this year that delayed the RMD requirement for 2020 altogether. So essentially between these three acts of legislation passed in the last several years, it's really extended the opportunity or window of opportunity for folks just like you to do some tax planning and potentially reduce some of your tax liabilities that would otherwise be heaping up and growing in the future. So Roth conversions definitely makes a list for tax planning opportunities here in today's Facebook Live. The last one is a bit obscure. It's your good old-fashioned HSA. So you might be asking, how does that really fit into tax planning or tax opportunities that's different than any other year, Devin? Well, what Congress did is they actually passed a notice. It's called a Notice 2020-15, which effectively allowed HSA plans to do a couple of things. First, kind of change the classification of what COVID testing and treatment would be in a high deductible plan, which you need a high deductible plan to get an HSA, which had allowed any of the testing and treatment of COVID-19 to be pre-deductible and not have any copay. So really allowing the majority of Americans to have access to COVID-19 treatment. But what also changed is you're able to make a one-time contribution from your IRA into your HSA. Now you're still subject to the limits of your HSA, be that $6,000 or $7,000 per year. However, remember, you haven't paid any taxes inside of your IRA, but now you're taking an amount, let's call it $6,000 for the year, and you're putting it into your HSA that you also don't ever have to pay taxes because you're going to use it for Medicare or for medical reasons. So you haven't paid taxes yet, and you're not paying taxes as you move into the future. And so that's why the HSA makes today's list of tax planning opportunities. So for our COVID-19 options right here, we had tax loss harvesting, mutual fund repositioning, Roth conversions, and then contributions to your HSA account from your IRA account. Now, all these are great planning opportunities generally as we speak to a large audience. However, there are tax planning opportunities that may be right for you or may not be right for you moving forward into your retirement. I appreciate everyone joining me here on this Facebook Live talking about tax planning opportunities in a COVID-19 era. Thanks, everyone.